Hi guys, welcome back to our YouTube channel, AlgoWise. So, in the last two videos, we discussed with Pratik the US inflation data and the jobless claims data from the US and how it had actually impacted the markets. So, Pratik introduced a new concept, which is like how uh, bad news has become good news for the markets in terms of rate hikes announced by the Fed. So, on 27th of July, US Fed announced a rate hike of 0.75%, that is 75 basis points. So again, that was already factored in the markets. So today we'll discuss more on that. And so we have Pratik. Welcome, Pratik.
Hi, Kalyan. So yes, I had been discussing about this thing, right? That bad news is going to become good news. If we are going to
Yeah.
get bad news from the market in terms of, let's say, the housing data or other data points, then it is likely to become a good news for the market. And that was basically what was happening. Like we were discussing last time that, okay, there are some bad news coming in from the housing market and some other things like consumer sentiment and how that is normally going to become an expectation that Fed rate hikes will become slower going forward, right? So that expectation along with some sort of pivot from the Fed. Pivot basically means that, let's say they are doing something, then they pause suddenly saying that, okay, we are not going to do this right now. We are going to do something different basically, or we are going to change course. So that pivot was expected widely by the market, because of which the market was sort of going up. And that is what has been happening. So now if you look at the actual data points, let me share my screen with you. You can see all the data points that are there. So if you can see the
Yeah.
US data points that had basically come out, which was sort of dictating a lot of global markets because of especially US dollar. But we'll go to that later. First, let's look at the data points, right? So if you look at the last 2 weeks, we generally had weaker data points, especially on the housing market. We were going below expectation. The consumer confidence has been dropping compared to 98.7 previous. We had an actual of 95.7. Then if you look at something like pending home sales, right? Pending home sales was down by 20%. That data basically came in on 27th of July. Along with that, on 27th of July, we had the Fed interest rate decision, which in which the Fed hiked by 75 basis point or 0.75 percentage. But at the same time, Fed also said that they are going to observe the market situation and they are going to probably decrease the rate hike pace. The pace of rate hike is expected to decrease because the economy is sort of slowing. So the Fed statement also changed. Earlier, the Fed statement started with the economy is doing pretty well or something in that line. But now the Fed is basically saying that the economy is slowing down. So that is also one of the things that market is expecting, that it's a Fed pivot. That Fed is saying that, okay, now they will slow the pace of rate hikes. And in fact, their official projection also forecast 50 basis point hike in the next quarter. Not next quarter, but in the next hike cycle. So if you
Okay.
look at this data point, so this is a data point which shows the next Fed meeting, which is on 21st of September 2022. There's an 80% probability that 50 basis point hike will happen, and there is only a 20% probability right now, based on the market expectation, that a 75 basis point may happen, right? So the rate hike expectations are slowing down also. 25 in this 21st September meeting. In the December meeting, the expectation is even less. It is around 25 basis point, right? And if you look at the market implied probability or the average distribution of what the market is really thinking about, the market thinks that the rates will become something around 3.25% by end of December. After that, it will start decreasing. That is kind of the expectation that the market is having,
Okay.
right? So because of these kind of things, the market is generally expecting that rate hike will slow down. At the same time, the inflation will also slow down. But Kalyan, we have a bigger problem at this point. So bad news is good news. That is what I was saying. The bad news has basically come in. And if you look at another bad news, which basically came in yesterday, which was the GDP growth rate. There's an advanced estimate of GDP growth rate that came out to be negative 0.9%. It's 2 consecutive quarters of negative GDP growth.
Okay.
Generally, recessions follow 2 negative quarters of GDP growth. Recessions happen after that. But
Okay.
at this point, it is not yet sure whether recession will happen or not. Technically, people may say it is already a recession, but there is a agency called as NBER who looks at different indicators to really pronounce whether it is a recession or not. They have not pronounced this as a recession because the job growth is good. The jobs are basically growing, and at the same time, the market is sort of buoyant, I can say. Or you can also think of it in this way, that this is the real GDP growth. Now, real GDP growth, I mean, if you think about nominal GDP growth, that is basically the sum of real GDP growth and inflation.
Correct.
Because inflation is outpacing your nominal GDP growth. That is why we have a real negative growth. So it's not that nominally prices are falling. Nominally, which means that suppose somebody was earning 100 rupees yesterday, today he is earning 107 rupees. But inflation is 8%, which
8%,
means that
yeah.
he has
So
to buy the same thing at 108 rupees.
8
He might
rupees.
be
So
earning
basically
more.
-1.
Exactly. So that is what is happening on the GDP growth. It's not that incomes are falling. Incomes are still rising on a nominal basis. But your real growth is falling because you have a higher inflation compared to the nominal growth.
Okay.
So this was another bad news that you can actually see. But this bad news was factored in somewhat into the market. I mean, people were not expecting a negative GDP growth. People were expecting very slow GDP growth of 0.3%, but it came in at negative. Now we have a bigger problem. The problem is that, okay, let's say even if we are able to control inflation by hiking rates, we are going to have very, very slow GDP growth rate, either negative or slow GDP growth rate. How do you get out of that situation? Nobody knows the answer to this. If you ask me, I also don't know. I think, in fact, many people do not know what is the solution to this. I mean, is there really a solution? Nobody knows. Fed will have to think about something innovative probably. So this is the bigger problem now that is coming for the market. So look, market, one thing in market can be expectations and reality. So incrementally there was negative expectation in the market. Comparatively less negative news came in, or the negative news that was basically coming in led to market believing that bad news is good news. But that can only go on for so long. It cannot go on continuously.
Exactly. That was that's what I was about to say, because something which has been factored in and taken by the market already, okay, that will go for some time only, right? But when we come to the reality is interest rates are getting hiked, monetary policy is getting tightened, and the supply of money is getting tightened. So that will anyways impact the markets, right? That will impact investments and everything. So in the long run, maybe considering 6 months, 7 months, 8 months.
Yes. In fact, if you look at the GDP numbers that basically came in, it came in negative because of a couple of things. One is housing. Housing investments have slowed down. Second is the government spending has slowed down. I was talking about it, the government spending with you, right, last time, that government spending will slow down if the interest rates keep on going up, right? So that is what is happening. Government spending is also slowing down. And also there is some sort of impact on some other sectors like investment. Like people are not investing money. Not people, but let's say companies are not really investing into real assets, or inventories are also down. People are not really stocking up inventory, right? Because your expectation is that the market is not performing well. So these are some of the factors or headwinds that are there in the economy. Now, with that in context, now there are a couple of things which is important to understand. Now, there was a huge slowdown in the NASDAQ or in the IT market. normally. If you think about the information technology or technology stocks, there was a lot of slowdown because of the expectation of huge rate hikes because of inflation and other factors. So that segment might actually start performing better now because the pace of rate hikes are going to slow down, and there is an expectation that in 2023 the rates will begin to come down again. So that segment of the market may again start performing well. But if you think about the other segments of the market, which is more dependent on what is the growth, because companies will have to make money, they will have to increase their revenue, they will have to increase their profits. Only if they do that, their stock prices will go up in the long term. Otherwise it won't, right? That you will
Yeah,
believe, that we will understand, right? If they do not make profits, they're not going to go up.
correct.
So that is the bigger problem with such kind of low GDP growth. Will we be able to generate more amount of corporate profits? Probably not. And if that doesn't happen, the global markets basically are going to look at a tougher time. But again, if I come back to Indian markets, I don't think that is the scenario, because in Indian markets there is a lot of population growth. There is a lot of demand that is already there. If you look at the data from the government in terms of GST collection, it has always been going up, which means people are spending money. GST is not just direct tax, right? It's an indirect tax.
Correct.
Indirect tax data basically means that spending is happening. People are going out and buying things. So if that continues, Indian market is going to be a relative outperformer. There is only one caveat once again. The caveat is that there should be no global financial crisis. It should not happen that Europe has a gas problem, they are not able to get any gas, and they are not able to produce anything. Because of that, they go into a deep recession. Because of that, there is a crisis between banks lending to each other. If those kind of things happen, then it is going to become a global problem once again. Otherwise, India is going to remain in a softer spot, and it should basically be good.
So recently, I saw like small clipping. So I think that was featured in one of the news channels. So it was like some agency, some reputed agency had done a survey, and there were economists behind that survey. And so, what's the likely probability, or what's the probability of countries having going into recession in the next 2 quarters or something like that, or maybe
Yeah,
four quarters or something like that. So
and
that
India was at 0%.
zero, yeah, correct. So that was like
Right.
uh, even you had the data for countries like Indonesia. Obviously, Sri Lanka would be there, and Pakistan and Bangladesh, all these countries, and Western countries like Australia, Canada, and US. Like most of the countries were there in that list. India, so the probability was, they say it's zero. So that's how confident they are. If you say like that there won't be
Yeah.
any such thing
Yeah.
happening in
Normally,
India.
India doesn't go into growth contraction. It only happened during COVID. Other than that, normally it never happens in India. Maybe there are external sector impacts, but it is absorbed into the diversified economy. And again,
Yeah.
if you look at the oil prices, right, that's the last thing I wanted to cover. So oil prices again are stabilizing around 100 sort of levels. You see it went up quite significantly, then it has stabilized around 100, which is a good thing. Like if there is a negative growth, if there is very slow growth, the chances of oil going up because of demand is comparatively low. But I think, Kalyan, you should also watch out for RBI's rate decision, which is going to be an important data points for Indian market
So
specifically,
that is
which is
5th
coming
of August, right?
5th of August, exactly.
Okay. So what's the expectation here? 0.25%, is it? 25 basis points hike?
It's a 50 basis point hike expectation, but let's see, maybe RBI will want to pause for some time. It is also possible because the inflation has been coming down.
Okay, okay, fine. So yeah, okay. So I think today's video we can stop it here, and in the next video maybe we can discuss this part, right? Even I also wanted you to cover the bond markets as well as the equity markets, and a detailed introduction to those terms, and also that will help our viewers, because a lot of things are happening in the bond markets which is like direct or some inversely proportional to what's happening in the equity market. So I think the terms you can explain, and as well as what's happening currently, I think that also you can explain in the next video.
Sure, sure. We can have a short discussion on that basically for 5 to 7 minutes.
Yeah. Okay. Thanks for joining, Pratik.
All right. Thank you,
Yeah.
Kalyan.
Yeah. Thank you. Bye.
Bye.